कौन सा एएस करना है आज? एएस 15 से स्टार्ट करें क्या? देख, हेलो, इसको चल now everyone, very good morning everyone. Everyone fine? I am also very fine. Now let us complete the balance accounting standard. Whatever accounting standard left for the revision, we'll start with AS 15. AS 15. So AS 15 is for employee benefit. Now in AS 15, can I say all the employee benefit will be applicable? Means the standard is applicable for all EB expense. Yes or no? Except what? Except any employee share based payment. Means if any payment is done in the form of shares, so ESOP is not covered in this chapter. Apart from that, all EB expense will be covered in this chapter. Now when I say employee benefit, in that employee will include all types of employee, whether it is unskilled employee, semi-skilled employee, skilled employee, full-time employee, part-time employee, salana employee, dikra employee, whole-time director, manager, anything. Employee means employee. But they want to just give a clarification that it will not include any contract labor or trainee because they are not employed. So any contract labor means they are actually recruited from some agency. They are employee of that agency, not the entity. So they are not employed. So what do you mean by employee benefit? Employee benefit means all the form of consideration payable by entity to employee for the service rendered by employee during a particular period. So any form of consideration, whether paid in cash or in kind, will be employee benefit. Now such employee benefit may arise either due to formal practice. Formal practice means we call it what? Contractual agreement. Contractual agreement. Or due to some informal practice. So sometimes without contract also we pay some amount to what? Employee, for example, any reward or prize, etc. So that will be from informal practice. Or due to some legislative requirement, means legal obligation, that is PF, ESI, gratuity, etc. Correct? So all types of employee benefit will be covered, whether it is arising from formal practice, informal practice, or any legislative requirement. Understood? Now for the purpose of accounting treatment, all types of employee benefit are divided into 4 categories. One is short-term employee benefit, long-term employment benefit, post-employment benefit, termination benefit. So short-term employment benefit means any employee benefit which are payable within 12 months after the year end, means after the end of the period, correct now, in which the services are rendered. So within 12 months, if it is payable within 12 months from the end of the reporting period in which the services are rendered, that will become short-term employment benefit. Means it will include simple wages, salary, any profit sharing bonus, etc., which is payable within 12 months. It will also include short-term compensated absences. Short-term compensated absences, this I will discuss separately. Means in simple word, can I say this short-term employment benefit will be recognized as an expense and liability in the year in which services are rendered at an undiscounted amount. Means will not use discounting, will not use discounted amount. It will be recognized at undiscounted amount. Means simply if the amount has been paid and benefit is received, the journal entry is what? Employee benefit expense, account debit to cash or bank. If the amount is not paid, then we will recognize the liability. Then EB expense, account debit to payable. And if suppose some amount we receive in advance, means from employee it is in advance. Suppose some amount has been paid in advance. So what journal entry? Prepayment. Means we'll do prepaid EB expense, account debit to expense. Correct now? Prepaid EB expense, account debit to cash or bank. It will be cash or bank. Okay. Now normally can I say when I am saying EB expense, so this EB expense will be charged to profit and loss account unless it is capitalized as per the requirement of other accounting standard. For example, in case of inventory, we add direct labor expenses. We also add indirect labor expenses. In case of PP, also some employee benefit expenses which are directly attributable for bringing the asset in present location and condition for its intended use will be also capitalized. So it can be capitalized as per the requirement of other standard. Otherwise, it will be charged to profit and loss account as a expense. Now coming to short-term compensated absences, so I hope you remember we have discussed this point that if suppose some leave is granted, so that leave can be of two types, whether it is unvested or vested. Correct now. Unvested means what? He will get, the employee will get leave against leave. When I am saying vested, to employee will get cash payment against that leave if that leave is unavailed. If that leave is unavailed. So what will be the accounting treatment of that short-term compensated absences that we are discussing? So if the leave is already availed during the period, then no accounting period. If the leave is availed during the period, then no accounting treatment, then ignore it. Now, if the leave is not availed, but it is non-accumulating means it will not be carried forward, then also no treatment, But if it is accumulating means which can be carried forward, so it can be vested, unvested. Vested means what? It is cash against leave, means some payment will be done based on the salary per working day. You need to just find out number of unavailed leave multiplied by salary per working day. So with that amount we'll pass one journal entry about and will create a liability. So what journal entry will do? EB expense account debit to payable. EB expense account debit to payable. Correct? So full amount of benefit is provided for such cost of leave. Amount will be what? Number of unavailable leave multiplied by salary per working day. Understood? But if it is leave against leave, unvested, leave against leave means leave will be given against the leave which remain unavailed. So it means the leave can be availed in the next year, means it can be carried forward only for the 1 year. It cannot be carried forward for more than 1 year. If it can be carried forward for more than 1 year, then it becomes long-term employment benefit. Right now we are discussing what? Short-term compensated absences. Understood? So in that case, we need to recognize the proportionate amount of cost of leave. Means we'll first find the number of unavailed leave multiplied by the probability of availment. For example, as per the past experience, the employee can only avail 2 out of 10 unavailed leave. So it means we need to recognize expense only for 2 leave, not for 10 leave. Understood? So we'll calculate proportionate cost of leave. Understood? So what will be the formula? Formula will be what? Number of unavailed leave multiplied by the probability of availment multiplied by salary per working day. Understood? Have you understood this point? Now, can you say the probability of availment should be given the question? If not given, we'll assume that it is 100% probable. Means then we'll multiply with the salary per working day with the number of unavailed leave. Understood? So this information will be given the question and will create provision. So what journal entry will do? EB expense account debit to provision for compensated absences. Now next year, this provision will be reversed. Next year this provision means whatever provision we have created in current year, next year it will be reversed. Understood? However, reversal journal entry they will not ask, they will ask current year journal entry only. So current year what journal entry we are doing? EB expense account debit to provision. Understood? Provision. Why provision? Because it is an estimated amount. Chalega? Yes sir. So short term employment benefit this much only. Now let us come to post employment benefit. Post employment benefit means what? Any employment benefit that are payable after retirement, after the completion of employment, that become post employment benefit. Other than short term employment benefit or termination benefit, means some short term benefit amount may be payable after retirement, so that is not post employment benefit. Termination benefit is always payable after retirement only, so that is also not post employment benefit, other than short term employment benefit and termination benefit. Now for the purpose of accounting treatment, this post employment benefit are of two types. One is defined contribution plan, one is defined benefit plan. In case of defined contribution amount, a fixed amount is contributed by employee to a separate entity that is known as plan asset. Correct? So fixed amount is contributed by entity on behalf of employee. That is known as employer contribution. Means actually what happened, employee will also contribute and employer will also contribute. So right now we are not discussing about employee contribution. Employee contribution will be automatically covered in short term employee benefit. We are discussing about employer contribution. So a fixed amount will be contributed by whom? Employer to a separate entity. That separate entity is known as plan asset. Correct. And once the amount is contributed, now there is no further obligation to contribute any amount in case of insufficient fund in that plan asset. Means can I say now that plan asset will pay directly to the employee on retirement. So once the employer has contributed amount, they do not have any other obligation. They do not have any other obligation. Means all the risk of that plan asset, all the risk, whether it is actuarial risk or investment risk. Remember, investment risk, actuarial risk will fall onto whom? Employee. Therefore, once the amount is contributed or once the entity is liable to contribute, they will recognize an expense and liability with that amount. With that amount, understood? Correct. So, what they said? Defined contribution plan is a plan under which entity pay a fixed contribution to a separate entity, that is plan asset, and will have no obligation to further contribute if the plan asset does not have sufficient fund to pay employee. Correct. So employer contribution to defined contribution plan is recognized as an expense and liability when the employer is liable to contribute. However, if such amount is payable after 12 months, then it should be recognized as an expense and liability with a discounted amount. Understood? So if such amount is payable after 12 months, normally it is payable within 12 months only. Normally, correct. But if it is payable after 12 months from the end of reporting period, then we recognize expense and liability with discounted amount. Rate of discount will be given. You can find out present value. Understood? But normally they will not ask this point in exam. Means normally it is payable within 12 months. So we will recognize that undiscounted amount. Chalega. Now, defined benefit plan. This is more important from examination point of view. Defined benefit plan. So under this plan, what an entity has an obligation to provide. In this defined benefit plan means what is the difference between defined contribution plan and defined benefit plan? In case of defined contribution plan, the amount of contribution is fixed. Means we know what amount need to be contributed. But in case of defined benefit plan, the amount of benefit is known, but amount of obligation is not known. Means what amount entity is supposed to pay, that is not known. So that is known as defined benefit plan. Benefit is fixed, but the amount is not known. So can I say once the amount is not known, so we need to estimate it. But can I say since the amount is payable after retirement, and right now suppose an employee has joined, so he may retire after 1 year, he may retire after 5 years, he may retire after 20 years, he may retire after 40 years. So there is lot of uncertainties involved. So it can be a long period. So because lot of uncertainties involved, therefore can I say an estimation is required, and that estimation is done by an expert known as actuary. So actuary will provide the amount which is payable after retirement. That actually is given by actuary by way of their estimation. Understood? Correct. Understood this much? So in this plan, can I say normally in this plan employee contribution is not required, because employee contribution is not required. Only employer contribution is required. Correct. Now in this case we need to calculate. This actuary will estimate the amount. Based on what? Various uncertainties on the basis of some actuarial assumption. This actuarial assumption can be of two types. One is known as financial assumption, one is known as demographic assumption. Financial assumption means assumption regarding discount rate, assumption like growth in salary, assumption required, for example, expected rate of return. This you will understand all these assumptions. Okay. Demographic assumption means labor turnover rate, whether employee will leave the job or will not leave the job, mortality rate, retirement rate, etc. So you need to only remember these two words, demographic assumption and financial assumption. So these are the actual assumptions on the basis of which amount can be estimated. Amount can be estimated. So to explain this, what I will do, I will just take one example so that a recap ho jayega. However, this type of question normally they don't ask, but if they ask, so how to calculate the amount of obligation? For example, for example, suppose entity has announced a gratuity plan. Correct? Understood? And it is 40% of last drawn monthly salary multiplied by number of completed year of service. Correct? Understood? So we need to estimate what will be the number of year of services. So that will be given the question. Okay, let us assume number of completed year of service is equal to 5 years. Understood? We need to also estimate the growth rate in salary. Growth rate in salary. Let us assume 10%. We will also assume discount rate. However, discount rate is based on the yield rate of government bonds. Discount rate is based on what? You can see one is given ki to calculate present value of discount rate should be determined by reference to market yield of government bond on reporting date. Market yield on government bond on reporting date. So what will take the yield rate of government bond, that will become discount rate. However, that will be given the question. Let us assume it is 13%. Let us assume it is 13%. And they will give you current salary. That will be actual. So let us assume current salary is 10,000 per month. 10,000 per month. And they will ask you to calculate what? They will ask you to calculate, one is current service cost and one is interest cost, and third is present value of defined benefit obligation. Present value of defined benefit obligation. So in this first, what we will calculate, Bata? First we will calculate what? Last drawn monthly salary. So that will be what? 10,000 into 1.10, 1.10, 1.10, 1.10. So you can see 4 times will do. Means this is year 1 salary, this is year 2 salary, this is year 3, this is year 4, this is year 5. So after 5 years, means at the end of 5th year, this will be what? Last drawn monthly salary. But in one of the ICAI solution, if you remember, they have done multiplied by 5 times. So if that question come, I said do in that way only, if you remember. Remember? If that same to same question come. Okay. Got this point? But this is last drawn monthly salary is this only. Correct? So this is coming how much, can you say me? 14641. So now we'll calculate projected benefit. So projected benefit will be 40% of 14641 multiplied by 5 year, na? Multiplied by 5 year. Number of completed year of services. No. 40% of last drawn monthly salary. It is not annual salary. It can be annual salary also. Then you will do multiply by 12. So I have given last drawn monthly salary. It can be last drawn annual salary also. So annual salary, so 40% of annual salary you will do. 40% of annual salary you will do. Understood? That will depend upon the information given in the question. So it is become how much? Can you give me the amount? 29282. Correct. Now we'll do calculate allocated benefit. Allocated benefit. So this will be allocated into how many years? 5 years. 29282 divided by 5. How much? 5856. So guys, this is the amount payable at the end of 5th year for how many years? For 5 years. So now we'll calculate current service cost. So current service cost year 1, year 2, year 3, year 4, year 5. So what is the allocated benefit? That is 5865, 5865, 5865, 56. 5856 na? Yeah sir. 5856, 5856, 5856, 5856. Now this is payable after how many years? No, 4 years. Because this is actually calculated at year end 1. So year end 1, so this is payable after how many years? 4 years. This is payable after 4 years. This is payable after? This is payable after? This is payable after? This is payable after 0 years. It means, can I say, we need to now find discounting factor at what rate? Whatever given rate, 13%. 13%. So this will become y0. This will become y1. So do right back from back. So this will be 1, 0.88, 3 decimal did it? 87, this 884, then 0.783, then 0.69, then 0.613. Now can you find out current service cost? Three 3590 4058 4620 5176. This become current service cost. Correct. Now we'll do calculation of what? Calculation of interest and present value of DBO. For that we'll prepare one liability statement for each year. Year 1, year 2, year 3, year 4, year 5. Okay, this actually statement we are preparing at year end 1. We are preparing at year end 1 based on the assumption taken at year end 1. But assumption may change in second year, third year, fourth year. So this liability statement may change for second year, third year, fourth year, fifth year. Understood? So on the assumption that assumption will remain same, we are preparing one liability statement at year end 1. So first we'll add an opening balance of what? Liability. In this we'll add what? Interest cost. Then we'll add what? Current service cost. This will become what? Closing balance of liability. Liability means present value of DBO. Correct. So first year it was nil. So this is also nil. What is the current service cost? 3590. So closing balance 3590. Then it will come 3590. Interest will be what? Into 13%. Na? 13%. It will 467. Then current service cost. This one 4058. So it is 8115. Now you can proceed. And the last amount, this amount will be what? Projected benefit, that is 29282. 29280. So last calculate interest as a balancing figure. You can do it. So what journal entry we are doing for current service cost? Journal entry is current service cost account debit, interest cost account debit to present value of DBO. This interest cost and this both will be transferred to what? PL. Understood? Correct. This much you understood. So you have understood current service cost, you have understood interest cost. Am I right? Now Can I say if there is any changes in actuarial assumption in the second year? So this opening liability has been calculated as per old assumption. But opening liability as per new assumption can be different. Either it can be more than or less than this amount, because the assumption will change, so this amount will change. So any increase in liability, opening liability, due to changes in actuarial assumption, which is known as actuarial loss. Any decrease in opening liability due to changes in actuarial assumption is known as actuarial gain. So there can be some actuarial gain or loss due to remeasurement, due to changes in actuarial assumption. So that is known as actuarial gain or loss. That is also transferred to PL of that particular year when changes occur. Understood? So that is known as actuarial gain or loss. So what will be journal entry for actuarial gain? Present value of DBO to actuarial gain, and gain will be transferred to PL. What will be journal entry for actuarial loss? Actuarial loss to present value of DBO. Correct? So they will not ask the calculation of that. They may ask only what, where it is transferred to PL or what. So you can see calculation of current service cost. So what is journal entry for current service cost? Current service cost account debit to present value of DBO. What do you mean by actuarial gain or loss? Are changes in the present value of defined benefit obligation resulting from the effect of changes in actuarial assumption. So what journal entry if actuarial gain? Journal entry is actuarial loss. Journal entry is actuarial loss to present value of DBO. What journal entry for actuarial gain? Present value of DBO to actuarial gain. Both will be transferred to PL. Interest cost is calculated on opening balance of liability. Opening balance of liability. What journal entry? Interest cost account debit to present value of DBO. Understood this much? Correct. This much. The next point in this is for plan asset, which is important. Normally they ask question from plan asset. Normally they ask question of plan asset. So now in this also, can I say even though not legally required, means in case of defined contribution plan, so it is legally required to contribute to some plan asset. But in case of defined benefit plan, it is not legally required. But then also can I say for planning the payment in future, they contribute this amount of current service cost to a separate entity that is known as plan asset. That is known as plan asset. So in the same way, the amount will be contributed by employer to a separate entity known as plan asset. That plan asset will do further investment. Whatever return is generated with the investment amount, that will be given back to whom? Employer or employee? Employer. Employer. Therefore, can I say entire investment risk and actual risk in this case will fall on to employer. Therefore, this amount of contribution is not an expense, that is an investment, and we'll recognize one plan asset in the books of account of entity. We recognize the plan asset in the books of account of entity. Means in case of defined contribution plan, defined contribution plan, DCP, amount is contributed to a separate entity known as plan asset. But can I say employer does not have any further obligation, because in that case the plan asset will directly pay to employee. So if there is any deficiency, employer does not have any other obligation. Therefore, whatever amount contributed, that become expense of that year. But in this case, it is just like an investment. The amount was contributed to whom? A plan asset. The plan asset will return the amount to whom? Employer. Therefore, all the risk, whether it is investment risk or actuarial risk, will fall on to whom? Will fall on to whom? Employer. Therefore, it is just like an asset. Therefore, in the books of entity, we will recognize a plan asset. Plan asset. Understood? Correct? Understood. Now, it means, can I say we need to prepare one plan asset account? We need to prepare which account? A plan asset account in the books of entity or employer. So, for contribution to plan asset, what journal entry? Plan asset account debit to bank. Plan asset account debit to bank for contribution to plan asset. Correct? Understood? Now, can I say whenever any obligation, whenever any benefit is payable to employee, whenever any benefit is payable to employee, so employer will withdraw the amount from where? Plan asset only, and then they will pay the amount to whom? Employee. So first they will withdraw from where? Plan asset. What journal entry? Means cash or bank account debit to what? Plan asset. and that whatever amount received, that will be given to whom? Employee, for reduction of liability. So what journal entry? Present value of DBO to cash or bank. Means there are two journal entry. First withdrawal from plan asset, then payment to employee. Understood? Correct. Now this become a plan asset. So on plan asset there will be some return also. So we recognize one interest income based on expectation, based on the expectation of employer. That is known as expected rate of return. That is known as expected rate of return. So we recognize one income that is known as expected return. Expected return. Expected return. Understood? Based on expected rate of return, that will be given in the question, nothing to worry. Correct? But can I say actual return may or may be more than or less than expectation? If the actual return is more than expectation, it means that is an actuarial gain. If actual return is less than what expectation, that become actuarial loss. Understood what I am saying? So if the actual return is more than expectation, there is an actuarial gain. What journal will do? Actuarial gain to plan asset. We write down to actuarial gain. Understood? And if there is a loss, then what? By actuarial loss. Means there are two actuarial gain or loss. One is actuarial gain or loss on DBO. One is actuarial gain or loss on plan asset. Understood? The net actuarial gain or loss will be transferred to PL. The net actuarial gain or loss will be transferred to PL. This is important from exam point of view. They will ask plan asset. They will ask plan asset. This much have you understood? This much you understood. So what journal entry batao? For contribution to plan asset, what journal entry? Plan asset debit to cash or bank. For benefit paid out of plan asset, so there are two journal entries. First withdrawal from amount withdrawn from plan asset. What journal entry? Cash or bank account debit to plan asset. For benefit paid to employee, present value of DBO to cash or bank. Then for recognition of interest income of plan asset by using expected rate of return. What journal entry? Plan asset account debit to expected rate of return. Understood this point? Have you understood this point? Means can I say interest cost on DBO is calculated based on discount rate, but interest income on plan asset is calculated by using expected rate of return. Expected rate of return. Understood this point? Then we'll calculate actual gain or loss. This is the difference between expected and actual. Means actual minus expected will be actual gain or loss. Correct? So for actual gain, what journal entry? Plan asset account debit to actuarial gain. For actual loss, what journal entry? Actual loss account debit to plan asset. How to calculate this actual return on plan asset? So one formula will be there. That formula you will use. We will first write down fair value of plan asset. Fair value of plan asset at year end. At year end. Then compare with the book value of plan asset at year end, which is equal to fair value of plan asset at beginning plus contribution received minus benefit paid. Minus benefit paid. The difference between these two will be actual return. Means if the amount is positive, then it is actual gain. I am saying actual, not actuarial. Actual. If the amount is negative, this is actual loss. It can be, return can be gain, return can be loss. Understood? Now to find out actuarial gain or loss, we'll compare actual return with what? Expected return. Understood? So that the difference will be what? Actuarial gain or loss. Actuarial gain or loss. This calculation is important from exam point of view. Understood this point? Same thing is given. You can see the same fair value of plan asset at year end less carrying amount of plan asset at year end. At year end. Understood? So how to calculate this? Fair value of plan asset at year beginning. Add contribution received less benefit paid. The difference is what? Actual return on plan asset. How to calculate actual gain or loss on plan asset? Actual return on plan asset less expected return on plan asset This will be actual year gain or loss on plan asset. Understood? ठीक है ना? One question I would like to take for this. Come to this example number 2. X Limited has a plan asset having fair value at year beginning of rupees 1 lakh. During the year, plan asset paid benefit of rupees 10,000 and received contribution of rupees 4 lakh 40,000. Sorry. Discount rate is 8% per annum and expected rate of return on plan asset is 10% per annum. Fair value plan asset at year end is 1,25,000. 1,25,000. Correct? Understood this point? Correct. So you need to calculate actual return on plan asset, interest income on plan asset, calculate actual gain or loss on plan asset. Now when I am saying during the year, we will assume that this contribution and benefit, this benefit is paid and contribution has been received at the mid of the year. We will assume whenever they have given during the year, we will assume it is done at the mid of the year. Means it can be also done at the end of the year, but if nothing is given, we will assume it is mid of the year. So that assumption will prevail. And if question is silent, we will assume this 10% is what? This 10% is what? Compounded half yearly. That assumption will take. Compounded half yearly. Do you know about compounded half yearly? So if nothing is given, we'll assume it is compounded half yearly. So this is 10% per annum compounded half yearly. Just write down this as a note that this assumption has been taken. This assumption has been taken. So first we'll calculate what actual return on plan asset. Batao. So what is the fair value at year end? 1,25,000. Then we'll compare with carrying amount at year end. So what is the fair value at year beginning? What is the contribution received? What is the benefit paid? So this become how much? 1,30,000. So actual return, write down in negative. Okay. Actual return is 5,000 negative. 5,000 negative. Chalega. Now we'll calculate expected return. So that will be based on the first 6 months. The first 6 months it was 1 lakh into what? 10% into what? 6 by 12. How much? 5,000. Then last 6 months it was 1 lakh plus what? 40,000 minus what? 10,000 plus what? Because it is compounded half yearly into 10% into 6 by 12. How much? 6,750. So what is the expected return? 11,750. Now I'll find out actuarial. So there is an actuarial loss again. So there is an actuarial loss. Loss na. So what was the actual? Actual return was negative 5,000 and expected is how much? It is 11,750. It means your actuarial loss 16,750. Understood? So what account will prepare? But the plan asset account. If suppose they ask, so what is the opening balance? 1 lakh. How much contribution received to bank? How much benefit paid out of that? So by bank 10,000. To expected return how much? 11,750. And by actuarial loss how much? 16,750. Closing balance will be how much? 1,25,000. Check karo. So this is the account. This is the account. Understood? So normally in exam we expect this type of question. I mean, this is one of the questions which can be asked in exam. This plan asset. Understood? One question has been given in study material, so do that. That question will be only asked. Chalega? Easy? Yes, sir. This also you have understood. The next point is what past service cost. Now what happened? Sometimes the plan is modified or any new plan has been introduced or any old plan has been withdrawn. Because of that reason, there will be some past service cost. Suppose a plan has been modified. Suppose the question was 40% of last drawn monthly salary. Now this has been modified from 40% to 50%. So can you say if you are in the second year or third year, so there will be some past service cost because of that modification. There will be some past service cost because of that modification or a new plan introduced right now. So if new plan introduced today, so for employee which have already worked for last 2 year or 3 year, they will have some past service cost, or there may be some withdrawal of plan. So if you withdrawn, so can it say there will be some past service cost which will be reduced, because the present value of DB will reduce. The past service cost can be negative or positive. It can be negative or positive. Are you getting what I am saying? Correct. So normally in exam they will give you what positive only past service cost means that will increase the present value of DBO. They will increase the present value of DBO. So what will be the accounting treatment of that past service cost? So they may ask you the accounting treatment. So any past service cost for vested plan means the plan is already vested. Plan is already vested means what? The condition has been satisfied. Suppose they have given that minimum year of service should be 5 years and some of the employee have already completed 5 years of services. So for that plan is already vested. So for those employee for which plan is already vested, past service cost will be recognized to PL immediately. Past service cost will be recognized to PL immediately. But suppose out of 5 years, some employee have only rendered service for 2 years. So that become unvested. Right? So the plan is not vested because they need to also complete how much 3 more years of services for getting the benefit of that plan. Understood? So that become unvested plan. So for unvested plan, the past service cost will be recognized not immediately. It will be deferred and will be recognized during remaining vesting period. Will be recognized during remaining vesting period. Understood? Correct. What is the accounting treatment? Past service cost may be either positive or negative. Past service cost to be recognized as an expense on a straight line basis over the average period until the benefit become vested. Means if the plan is unvested, what journal entry you are doing? Unrecognized past service cost to present value of DBO. Unrecognized past service cost to the present value of DBO, and this will be amortized, or you can say unamortized also. Better write on unamortized. It is unamortized past service cost to present value of DBO, and this unamortized past service cost will be amortized to PL during remaining vesting period. Okay. But if the plan is already vested, then what journal entry do? Past service cost to present value DBO and the past service cost will be charged to PL immediately. So this is very important. They will give you some amount and they will ask you if for which employee it will be charged to PL immediately, for which employee it will be deferred and will be amortized in remaining vesting period. So for vested immediately, for unvested during remaining vesting period. This much only need to remember. Understood this point? The next point is curtailment and settlement. Curtailment means what? Sometimes what happens, the employee numbers are reduced. Number of employee reduced due to some closure of factory, etc. Suppose you have closed on one factory, so number of employees will reduce. So at that point of time, this is known as curtailment. So due to curtailment, can you say present value of DBO will decrease because now you are not supposed, because of course the plan will become what? Expired. Plan will automatically be cancelled now. So whatever plan has been announced, that will be automatically cancelled. So that is known as curtailment. But curtailment can be with settlement, without settlement. If curtailment is with settlement, then we need to find out what is the gain or loss on settlement. So gain or loss on settlement will be what? The settlement price paid minus present value of DBO. If you are paying more, so that become loss. If you are paying less, that become gain. But sometimes curtailment is without settlement. So entire amount will be gain. So they may ask you also this, what will be the curtailment gain? Just try to understand. Suppose present value of DBO For one, I'm just writing for 1000 employee is 1 lakh. I'm just giving one question. And there is one unamortized past service cost. Unamortized past service cost 10,000. Understood? For how many employee? 1000 employee. Are you getting what I'm saying? So normally this is shown in the balance sheet as a net amount 90,000. It will shown in the balance sheet as a net amount. Correct? Understood? This point. Now they will say out of this 1000 employee, 100 employee reduced. 100 employee reduced. So you should proportionally decrease your present value DBO. Correct now? Are you getting what I am saying? So what journal entry you do? Present value of DBO will decrease by what amount? How much? Why not? No, no. Present value DBO will be reduced by 10,000 proportionately. 1 lakh is for 1000. So how much for 100? 10,000. And can you see you need to also reduce your unamortized past service cost proportionately. So for 10,000, for 1000 is 10,000. For 100 how much? 1000. And we suppose some amount is paid. Suppose some amount is paid. So difference will be gain or loss. But if some amount is not paid, so this entire become curtailment gain, and this curtailment gain is transferred to what? PL, that is 9,000. So normally they will ask this question, he calculate curtailment gain. So curtailment gain will be 10,000 minus 1,000, that is 9,000. They may ask one question of this nature. 5 marks, very simple. 5 marks, very simple. Understood? Have you understood this point? So that is curtailment and settlement. You can read this. So you can see journal entry present value DBO to unamortized past service cost, and that if some payment is done, okay, but any difference will be curtailment gain or settlement gain. Curtailment gain means without settlement. Settlement gain means with settlement. Chalega? Yes, sir. Now in balance sheet, how to present DBO and plan asset. So in balance sheet, how to present? So we write on present value DBO as reduced by unamortized past service cost as reduced by fair value of plan asset at year end. So this will become net defined benefit liability. Net defined benefit liability. So this way we show in the balance sheet. So in balance sheet we show the net amount. Net of plan asset. Net of plan asset. So they may give you this amount, this amount, this amount, and they may ask you what is the net amount to be shown in the balance sheet. So net amount to be shown in the balance sheet will be this amount. Understood this point? Chalega? Yes, sir. Correct. Then I think done. Then coming to long-term employment benefit. So for long-term employment benefit, the accounting treatment, whatever we have done for defined benefit plan under post-employment benefit is same to same. Only one difference is that in case of long-term employment benefit, entire past service cost, whether vested, unvested, will be charged to PL immediately. Only that is the difference. Otherwise, there is no difference. There is no difference. We can see recognition measurement. It is similar to defined benefit plan with following difference. All the past service cost is recognized immediately whether benefit are vested or unvested. However, they will not ask any question from long-term employment benefit. If question is silent, always give answer based on post-employment benefit. Don't give answer based on long-term employment benefit. Okay. Last is termination benefit. And termination benefit arises on termination. So either it can be due to employer decision to terminate or employer decision to opt for voluntary retirement. So in both cases, employer need to pay compensation to employee. That is known as termination benefit. That is known as termination benefit. Now termination benefit, can you see if it is payable after 12 months from the end of reporting period, then it will be recognized as discounted amount. But if it is payable within 12 months from the end of reporting period, then it will recognize that undiscounted amount. Only this much you need to remember. It will be recognized as an expense at an undiscounted amount if the amount is payable within 12 months. At discounted amount if the amount is payable after 12 months. Understood? This is termination benefit. Chalega. So with this we completed AS 15. AS 15 understood? Bolo. I think done? Chalo, AS 15 also done. Next AS is what? Come to AS 22. Accounting for taxes on income. Accounting for taxes on income. Now, because you have done this chapter, so accounting for taxes on income. So when I say tax expense, so tax expense is the aggregate of what? Current tax plus minus deferred tax. Current tax means what? Taxable income as per Income Tax Act. Now you know taxable income multiplied by rate of tax. So that become current tax. That become current tax. Now deferred tax means what? Deferred tax means what? If it is recoverable, if it is recoverable in future, if it is recoverable in future, so if some tax is recoverable in future, if some tax is recoverable in future, so we recognize DTA, deferred tax asset. But if it is payable in future, so we recognize deferred tax liability, deferred tax liability. So what journal entry will do for DTA? We'll say DTA account debit to deferred tax. So you can see deferred tax is credited, means it is one type of income. So if it is income, it will reduce your current tax. It will be deducted from current tax. So when you are creating DTA, it will be deducted from current tax expense. But when I am saying DTL, so what journal entry you are doing? Deferred tax expense account debit to deferred tax liability. So it means it will be added to what? Current tax. It will be added to current tax. This much you understood? Now, of course, we need to understand is how to calculate this deferred tax. So when it will be recoverable, when it will be payable, that we need to understand. For that purpose, what we do? We compare accounting income. We compare accounting income. Accounting income is PBT, profit before tax, with what? Taxable income. With taxable income. Understood? Now, of course, there will be some difference. Of course, there will be some difference. Understood? Of course, there will be some difference between these two income. Now, this difference can be what? Either timing difference or permanent difference. Or permanent difference. Understood? Permanent difference means that difference is not capable of reversal in future year. That difference is not capable of reversal in future year. Understood this point? Means any difference which originated in current year but are capable of reversal in future year, that become timing difference. That become timing difference. Means if I say permanent difference, expense, if it is disallowed, expense disallowed in current year will never be allowed in future. The expense disallowed under Income Tax Act will not be allowed in future. So that is permanent difference. Similarly, expense allowed in under Income Tax Act will never be disallowed in future. That is an item of permanent difference. That is an item of permanent difference. Are you getting what I am saying? Similarly, income also. For example, agriculture income exempted forever. So that is a permanent difference. That is a permanent difference. For example, additional depreciation allowed forever. Additional depreciation, weighted deduction, extra depreciation allowed forever. So that is a permanent difference. Are you getting what I am saying? So for that permanent difference, we don't create any deferred tax. No deferred tax. No deferred tax. Means can I say only for timing difference we create deferred tax? Means deferred tax will be equal to timing difference multiplied by what? Rate of tax. Timing difference multiplied by rate of tax. I hope you are understanding. Correct. Now only we need to understand when it will be DTA, when it will be DTL, that we need to understand. Correct. That will depend upon the nature of allowance or disallowance. Nature of allowance or disallowance. Means if I say expense disallowed in current year, but in future year it will be allowed. Just think in this way, in future it will be allowed. So you are paying higher tax or lower tax? Think about future, don't think about current. Are you getting what I am saying? So expense allowed in future year. So expense allowed means it will be deducted from taxable profit. If it is deducted from taxable profit, so we are saving some tax, and therefore in this year we will create DTA. And once it is allowed, we will reverse what? DTA. We will reverse, ये minus कर देंगे, यहाँ plus हुआ, plus DTA. Plus DTA means DTA is created. Minus DTA means DTA is reversed. Means we'll do reversal journal entry. Understood what I am saying? So DTA created in the current year will be reversed in the year in which it is allowed. In the year in which it is allowed. Correct? But if I say in this way, expense allowed, some expense is allowed in current year, which will be disallowed in future year. So disallowed means it will be added to taxable profit, means we need to pay higher tax in future. Therefore we'll create right now what? We'll plus DTA. Plus DTA means DTL is created, and in the year this year we'll do minus DTL, means DTL is reversed. Understood? Have you understood this point? Correct. So this, if you know this much, you can answer any question. Simple thing, whenever any doubt comes, now think about future. In future we are paying higher tax or lower tax due to that disallowance or allowance. If you are paying higher tax, create DTA right now and reverse in future years. Understood? If you are paying lower tax in future, to create DTA right now and reverse in future. Understood? Correct. I think you have understood this point. Correct? Any doubt? No doubt? Understood this much? So now we can come to the additional point of this chapter. Definition you can do. This you have understood, permanent difference and time indifference. This I am not explaining again. Now impact also you have understood. Taxes of initial year being higher and subsequent year being lower. So DTA. Recognize DTA. Okay? This all are given, just read it. Taxes of initial year being lower and subsequent year being higher. So DTL. Just read it. Therefore tax expense to DTL. Correct? So there is one special point about unabsorbed depreciation and carry forward of losses. So can I say any unabsorbed depreciation can be also deducted from future taxable profit. Similarly, any tax losses which can be carried forward in subsequent year can be also deducted from future taxable profit. So that will also save some tax in future. Means in future year once it is allowed, we are saving tax. So right now we'll create what? Deferred tax asset. Means can I say in this way, deferred tax asset is also created for unabsorbed depreciation which is carry forward and tax losses which is carry forward. Understood? Correct. So this is one special point. I hope you remember this point. Correct. Yes sir. This though chalo theek hai. Okay. Understood? This much you understood? Now coming to sometime what happened, as per income tax act there is no flat rate, there is a slab rate. So in that case we'll calculate average tax rate. We'll calculate first average tax rate. You know slab rate? Slab rate. So suppose right now what is the slab rate is going on, whatever going on. So you suppose taxable income is 1 crore. And you know the slab rate. So by applying slab rate, you can calculate current tax. Now current tax divided by what? Taxable income into 100. This will be average tax rate. Now deferred tax will be created based on what? This average tax rate. So whenever there is slab rate, so deferred tax will be calculated on what? Average tax rate. On that will not apply, means on timing difference will not apply slab rate. Okay. So can you see you can find out current tax? by using the slab rate. अरे बोलना yes or no? Divided by taxable income, so you will get average tax rate. So average tax rate will be used to calculate what? Deferred tax. Means average tax rate will be applied on timing difference. Will be applied on timing difference. Understood this point? Yes, sir. Now, this is one point of, if you remember, we have done one point of MAT, minimum alternative tax. So whenever there is a MAT, means for company or whatever, for any entity, we pay current tax, and current tax will be higher of what? Higher of regular tax, or MAT, whichever is higher. Whichever is higher. This only we have done now. Correct. So this will be your current tax. This will be your current tax. Understood this point? Correct. So in this case, one clarification has been given. Ki accounting for taxes of income in context of 115 JB of Income Tax Act. 115 JB is for what? MAT. I think MAT is not in your income tax, but they may ask question in what? Account, because one question has been given ICAI study mate, therefore I am doing it. However, they should not ask this type of question, but if they ask, the payment of tax under 115 JB of Act is the current tax for the period, means it is higher of that too. Now the doubt is what? If deferred tax should be created based on regular tax rate or based on MAT rate? Regular tax rate. This clarification has been given. So in a period in which company paid tax under section 115 JB of the Act, deferred tax asset and liability in respect of timing difference should be measured using regular tax rate, not the tax rate under section 115 JB of the Act. Understood? I like to revise one question of this, because if this question comes, so how to react in exam hall? Can I take one question? One question we have done in class now. There are many questions we have done. Second question. Chalo. This was the question. From the following details of A Limited for the year ended 31st March, calculate deferred tax as per AS2 and the amount of tax to be debited to PL account. So they have given accounting profit. Accounting profit means what? Profit before tax. Book profit as per MAT. This is calculated as per Income Tax Act, but on this we apply MAT rate. Then profit as per Income Tax Act means taxable income. Then they have given tax rate, then they have given MAT rate. Understood? Correct. So can I say first we'll calculate tax on accounting profit? Now one more thing. Here 6 lakh. This 6 lakh is tax accounting profit, and means taxable income is 60,000. The difference is what? So why there is a difference of 5,40,000? Means there are some expenses which have been allowed, which will be disallowed in future. So any expense which is disallowed and will be allowed in future, will calculate DT or DTL? Deferred tax asset. We create DT on that. We create DT on that. So on 5,40,000, on 5,40,000, no, DT will be created. This is expense allowed which will be disallowed in future. Which will be disallowed. So it will be DTL. You have said DT or DTL? DTL. So it will be DTL. Understood? This point have you understood? Now, how to calculate? Calculate. First we will calculate what? Current tax. Current tax will be higher of A. Regular tax. So regular tax, taxable income is given 60,000 multiplied by what is the regular tax rate? Is given 20%. So we will do 20%, how much? That is 12,000. Understood? Second we will do what? MAT. So MAT is 3,50,000 into 7.5%. I mean right now the rate, MAT rate is 18 point something. So that rate will be given in the question, nothing to worry. So 3,50,000 into 7.5%, how much? 2650. So it means current tax is equal to what? 26250. This become current tax. Understood? Correct. Now we need to find out deferred tax. So deferred tax will be what? 5,40,000 is the difference. So this is the difference between accounting income and taxable income. Accounting income and taxable income. This arises because of what? Expense allowed in current year, which will be disallowed in future. So when it is disallowed, we are paying higher tax. So on that we will create what? Deferred tax liability. So 5,40,000 into what? 20% is equal to how much? Is equal to 1,08,000. This become deferred tax liability. This become deferred tax liability. Understood this point? Any doubt? Now can you just try to understand? This difference you can say is what? 26250 minus 12,000. 14,250. Correct? So this is actually what known as MAT credit. Now as per Income Tax Act, if in the future year you are paying regular tax, so in that year you will get the benefit of this tax. Means can I say this is just like an advance tax? This is just like an advance tax. Are you getting what I am saying? So it means you need to create one advance tax for this. So what journal entry we are doing? First, current tax expense account debit to current tax liability. How much? No, 26250. 26250. Now can you see there is one advance tax, this MAT credit available, that become a advance tax for us. Correct now? 2PL. So this is how much? 14,250. 14,250. And then we create DTL. So deferred tax expense account debit to DTL. How much? 1,08,000. 1,08,000. So ultimately what is the net effect? Net effect become what happened? 26250 minus 14,250 plus what? 1,08,000. So your expense become what? 1 lakh. So your tax expense become 1,20,000. Your tax expense become 1,20,000. Understood? What is the expense they have given? Check karo. Your tax expense is equal to what? 1 lakh. They have also given tax expense 1,20,000. But they have calculated in some other way. This is what they have done. So follow this only in exam. Follow this. So they have first calculate taxes on accounting profit what? 1,20,000. Taxes on income tax what? 12,000. Tax on MAT is what? 26,250. Then they have given one formula. Tax expense equal to current tax plus deferred tax. So it is 1,20,000. First they have used regular tax 12,000 plus deferred tax. So automatic deferred tax will difference 1,08,000 they have calculated this way. We have also calculated that only now. So 1,08,000. Now amount of tax to be debited in PL account will be current tax plus deferred tax liability plus what? Excess of MAT over current tax. That only we have done. We have taken what? 26250 only now. So they have done what? 12,000 plus 1,08,000 plus 14,250. Ultimately we are doing that only. Ultimately we are doing means ultimately the tax expense. Ultimately what we are doing? अच्छा इसमें छोड़ दो, इसको ऐसे कर दो. Your current tax is what? इसको इंटर को छोड़ दो. 1,08,000 ना? This. So what is your expense? Current tax plus deferred tax. So this is 26250 plus 1,08,000. How much it is coming? 134. 250. What is the answer? 134, 250. So tax debited, they have given same. So you can use this presentation because ICAI solution is giving in this way. Once you have understood. Chalega? Correct. So this question is what? Already I have written MRQ. Must do before exam. However, this type of questions should not be asked at CA interlevel because this is thoda sa advanced topic. Advanced topic. Okay, sir? Yes, sir. So this also you have understood. Then we have done some condition for recognition of DTL. So we have understood DTL. For DTL there is no condition. Means we recognize DTL without any condition. But for DTL they have given some condition. That condition is based on some prudence level. So what they want to say is whenever entity does not have unabsorbed depreciation and carry forward losses. So we recognize DTA on all timing difference to the extent it is probable that sufficient, to the extent there is a reasonable assurance that sufficient taxable profit will be available against which DTA can be utilized. Means can I say DTA should be based on sufficient future taxable profit. If you have some taxable profit in future, then only we can get some advantage, otherwise we will not get any advantage. Are you getting what I am saying? Means it is as simple as just try to understand. When I am saying expense disallowed in current year, 1 lakh. So it will be allowed in which year? Expense allowed in next year 1 lakh. But you can get the benefit of this 1 lakh when you will have a taxable profit of 1 lakh. If you do not have taxable profit of 1 lakh, so you can't get that advantage. So it means in future when it is going to be reversed, you should have sufficient taxable profit. If you do not have sufficient taxable profit, you will not get that advantage of deduction. Correct? So why you are creating DTA? So what they are saying, DTA can be recognized only when there is a reasonable assurance that sufficient taxable profit will be available against which such DTA can be utilized. So this para you need to thoda sa memorize कि whenever entity does not have unabsorbed depreciation or carry forward losses under tax law, DTA should be recognized only if there is a reasonable certainty. Reasonable certainty means chances are more than 50%. That sufficient future taxable income will be available against which such DTA can be realized. Understood? We suppose there is one profit making company. There is a profit making company. So will you have any doubt about future taxable profit? No. So only what is required? Reasonable assurance required. But suppose there is a loss making company. So you will have a doubt or not. So in that case, what they say, there should be virtual certainty. So if there is a unabsorbed depreciation or carry forward losses, means it is a loss making company. So in that case, DTA can be recognized only when there is a virtual certainty with convincing evidence that sufficient taxable profit will be available against which DTA can be realized. Understood? So second point is what? When the entity has what? Unabsorbed depreciation and carry forward losses, means it is a loss making company. So for loss making company, more certainty is required. So that is virtual certainty, means more than 95% chances. More than 95% chances. So in that case, DTA should be recognized only if there is a virtual certainty supported by convincing evidence that sufficient future taxable income will be available against which such DTA can be realized. So these 2 points you need to thoda sa memorize. However, if question is silent, always we recognize DTA on the assumption that future taxable profit will be available. Okay, sir? Yes, sir. Then I think these all are not so important. Then one point we have done for tax holiday, if you remember. Tax holiday. Now you have done in tax holiday in your income tax act. So tax holiday means what? Exemption for income tax act for some year. For 10 year, 15 year, income tax will exempt normally in special economic zone. So any industry which is special economic zone, the first 10 year they will be exempted from tax to promote that type of industry. Correct? Now suppose this is the tax holiday, this is a tax holiday, this is tax holiday, but from this it will be tax school. Means there will be school now. Means you need to pay tax. There is no tax holiday. Okay? Are you getting? Now suppose there was a timing difference which originated यहाँ पर and which started reversing from the next year. 25, 25, 25 reverse. Now this is the timing difference which originated in tax holiday period, but some of these are reversing in which period, and some of these are reversing in after tax holiday period. So what AS 22 says that any timing difference which originated in tax holiday period and are reversing also in tax holiday period, so no advantage, no saving, no deferred tax. But if it is originated in tax holiday period but are reversing after tax holiday period, on that recognize what? Deferred tax. So we should recognize out of 100 only on what? 50. On 50 we should recognize deferred tax. Only this much you need to understand. I hope you have understood. So with this all the points we have understood. The balance point is not so much important from exam point of view. चलेगा, but एक बार देख लेना, ठीक है? Okay sir, understood. So AS 22 is also completed. Then come to AS 23. First we'll do AS 24. 24 हो गया. 27. Come to AS 27. Financial reporting of interest in joint venture. Financial reporting of interest in joint venture. AS 27. चलो AS 27, can we start? So financial reporting of interest in joint venture. Now what do you mean by joint venture? Joint venture is a contractual agreement whereby two or more than two parties undertake an economic benefit which is subject to joint control. Which is subject to joint control, not control. Joint control means A and B started a business, AB Limited, and AB have joint control. Joint control means both decisions are relevant, means unilateral decision can't be taken. Unanimous decision is required. Unanimous consent is required. Are you getting what I am saying? Are you getting what I am saying? Correct. So in that case, there are two special points. One is there must be contractual agreement. There must be contractual agreement. Means joint ventures start with contractual agreement. If there is no contractual agreement, they cannot be joint venture. So there must be contractual agreement. Means if I say partnership agreement is nothing but what? One type of joint venture. Correct. So contractual agreement, there must be contractual agreement with joint control. With joint control. Then there must be what? Joint control. So these are two conditions for joint venture. चलेगा? Understood? Means the contractual agreement establishes joint control over the joint venture, and such an agreement ensures that no single venturer is in a position to unilaterally control the activity. Understood now? So one single investor cannot control the activity. Either it will be two or more than two investors will be able to control the activity. That is known as joint control. Correct. Now for accounting purpose, all the joint venture are of three types. One is known as JCO, jointly controlled operation. One is JCA, jointly controlled asset. One is JCE, jointly controlled entity. Now when I am saying JCO and JCA means jointly controlled operation and jointly controlled asset, for these separate legal entity is not created. No separate legal entity. So no separate legal entity. But this JC is a separate legal entity. Understood what I am saying? Means can I say for jointly controlled operation, jointly controlled entity, as there is no separate legal entity, there is no separate books of account. So it means all the transactions will be recorded directly in the books of account of investor, books of account of joint venturer, books of account of joint venturer. Understood? Correct. So for JCO and JCA, it is very simple from accounting treatment point of view. So for JCA and ratio, the venturer means the investor, should recognize in his separate financial statement and consequently in consolidated financial statement. So from separate financial statement it will automatically come in consolidated financial statement. Correct now. Its asset including its share of any asset jointly held. Its liability including any share of liability which is jointly incurred. Its revenue including its share of any revenue which is jointly earned. Its expense including its share of any expense which is jointly incurred. For example, just try to understand. I'll just give you a very simple example. Suppose I and you, any of you, started as CA foundation coaching classes. Understood? Correct? Or let us say 4 persons. Mr. X, Mr. Y, Mr. Z. और ये कौन है? X से पहले क्या आता है? W. W ना? चलो. These are 4 persons. Now this person teaches accounts. This person teaches maths. This person teaches law. This person teaches economics. So 4 subjects. Now all are teaching CA inter classes. Means they have their own business. They have their own business. Means in CA inter, he teaches account, he teaches FM, he teaches law, and he teaches what? Audit. Understood? So they have their respective business in CA inter. Means already they are preparing their books of account for this business. Are you getting what I am saying? Now they started a joint venture for what? CA Foundation. CA Foundation without creating any separate legal entity. If they created a separate legal entity, then it becomes jointly controlled entity. Means they joined together and started CA Foundation classes. Quite possible. Quite possible na? Without creating any legal entity. Now what happened? This W has given one asset, X has given another asset, contributed one asset, Y has given asset 3, Z has given asset 4. Quite possible. And they also purchase some joint asset for the operation. Quite possible. Understood what I am saying? And can I say they will generate some income, they will generate some accounting income, maths income, law income, and economic income, and there will be some other income also. Similarly, there will be some expenses for accounting expenses, maths ka expenses, law ka expenses, economic expenses, and some other expenses which are jointly incurred. Correct. Now, in the books of, in the separate books, means in this book only na, of Mr. W, here this asset will come entirely, and the share of asset which is jointly held. Correct. Can I say in the separate books of Mr. W, accounting income will come and share of income of what? Other income will come. Are you getting what I am saying? Now in the books of accounts teacher Miss W, accounting expense will come and share of expense which is jointly incurred will come. Understood? And as the case may be in other books also. Now you will be able to understand what I am saying. In the books of venturer, in the separate books of venturer, each asset including its share of any asset jointly held. Its liability including share of any liability incurred jointly. Its revenue including share of revenue which is jointly earned. Its expense including any share of expense which are jointly incurred. Understood? Correct? Similarly, when it is jointly controlled assets, suppose two entity has purchased one asset for their mutual benefit. For their mutual benefit. Are you getting what I am saying? So one asset, because that was very expensive asset, so they purchased as asset for their mutual benefit. For example, we are two teachers, we require one camera. So I said I will use camera in the morning, you use camera in the evening. So one asset jointly held asset na, jointly held asset. So in that case, what will come? So if share of jointly controlled asset, we suppose 50-50. So 50% share will come in my books, 50% share will come in his books. Is liability including share of any liability incurred jointly? Suppose we have taken this camera by taking loan, so loan will also come. Is revenue including share of revenue? Suppose we are generating some income from this camera, we are giving on rent, so rent will be jointly income, that will be also shared equally. Is expense including his share of any expense jointly incurred? Same thing, means accounting treatment remain same. So for jointly controlled operation and jointly controlled asset, accounting treatment is same. Now let us come to jointly controlled entity. Jointly controlled entity. So jointly controlled entity, so it means suppose this is the venturer A Limited. There are two venturers, A Limited and B Limited. This is their separate balance sheet, and there is a jointly controlled entity AB Limited. AB Limited. Understood? So in the separate balance sheet of A Limited, B Limited, this will be investment. This will be shown as investment. Means any investment done will be shown as investment. As per AS 13. As per AS 13. It is as simple as for subsidiary company. We write down in separate financial statement investment as per AS 13 in the books of parent company. Now, in the consolidated financial statement, correct? Suppose A Limited has 40% and B Limited has 60%. Correct now? So, A Limited will incorporate all asset, all liability to the extent of about 40%. And B Limited will incorporate all asset, all liability to the extent of 60%. Means we will follow proportionate consolidation method. Proportionate consolidation method. Will follow proportionate consolidation method. Means can I say apply consolidation method whatever you have done for subsidiary, proportionate basis. Proportionate basis means whatever you have done there full basis, here we will do proportionate basis. Can I say when we apply proportionate consolidation basis, minority interest will not come, MI will become 0 because we are only incorporating 40%. We are incorporating only 40%. Understood this point? Have you understood this point? Yes, sir. So what they are saying? In separate financial statement of venturer, investment will be accounted as per AS 13. In consolidated financial statement venturer, correct, venturer should report its interest in jointly controlled entity using proportionate consolidation method, PCM. PCM. Now one doubt will come, sir, A hold 40% and B hold 60% in AB Limited. So sir, this to we have understood, we will apply PCM. But because this will give rise to control now. It will be the definition of control. Yes or no? So one doubt will come. Sir, here we will apply PCM of full consolidation method. So one doubt will come now. Are you getting what I am saying? I hope you have understood this point. Some note is given or not given? What given? Joint venture with contractual agreement will be excluded from the scope of AS 27 only if the investment qualify as subsidiary under AS 21. In this case, it will be covered by AS 21. Understood? So here one clarification has been given. Here to for B, what is will be applicable? AS 21 will be applicable. AS 21 will be applicable because it will meet at a control definition. So control definition means what? AS 21 will be applicable. Correct? Means for A Limited will follow what? PCM. For B Limited will prepare what? Full consolidation. Full consolidation means whatever we have done in consolidation chapter as per AS 21. Chalega? Understood? Yes, sir. Correct. Now, how to apply proportionate consolidation method? This procedure for proportionate consolidation. Following point will be kept in mind. Means apply the rules whatever you have done in consolidation chapter. Only some difference. He recognize goodwill or capital reserve same as per AS 21. Means calculate goodwill and capital reserve as you have calculated in AS 21. Means PC means cost price of investment minus proportionate share of fair value of INA. Correct. Then minority interest will not be recognized. No MI will come. Intercompany debt will be cancelled but proportionately. So 40% will cancel only 40%. Unrealized profit or loss will be cancelled but proportionately. So there we used to cancel full. Here only proportionate cancellation will be done. Only this point you need to keep in your mind. Then discontinuing the use of proportionate consolidation method. Discontinue the use of proportionate consolidation method. Correct. So when to discontinue, this type of question can be asked in MCQ format or theoretical question also. So venturer should discontinue the use of proportionate consolidation method if it ceases to have joint control in the joint venture but retain either in whole or in part some other investment. Suppose they were holding 40% but they have lost joint control, but they are holding some investment either full or part. It does not mean it is a joint venture, so we'll discontinue PCM. Or the use of proportionate consolidation method is no longer appropriate because the joint venture operate under some severe long-term restriction that significantly impair its ability to transfer fund to the venturer. Means there may be some long-term restriction due to some legal requirement कि the joint venture cannot transfer fund to their investor. So there is no economic benefit. If suppose there is some restriction by the government etc. कि joint venture cannot transfer fund to their investor, so there is severe long-term restriction, no economic benefit. If there is no benefit, then why consolidation? No consolidation. Correct now. Understood. So this is a special point which is a very rare situation. Understood. Can I say from the date of discontinuing the use of PCM, means from the date when we are not applying PCM, then how to report that investment? It is quite possible if the interest in the entity is more than 50%, then AS 21 will be applicable. If the interest is 20% or more but less than 51%, then we will apply AS 23 equity method. For all other investment, we will apply AS 13, means investment will be recorded as per AS 13. Then one more point is the exemption from PCM. When entity is exempted from proportionate consolidation method, the first one, an interest in a jointly controlled entity which is acquired wholly for the purpose of what? Subsequent sale, which is acquired and held exclusively with a view to his subsequent disposal in the near future. Means that has been acquired for the purpose of sale. So if that is required for the purpose of sale in near future, so no economic benefit and therefore it is exempted from PCM, proportionate consolidation method. Or an interest in jointly controlled entity which operate under severe long-term restriction that significantly impair its ability to transfer fund to the venture. Similar point, then also they are exempted from consolidation. So whenever they are exempted from PCM, then investment will be recognized as per what? AS 13. As per AS 13. Correct? Understood. So this was some point related to. So I will say that there are some questions given in ICAI study matter. That question will be only asked. Do it. Do it. Correct now. They will not create any new question on this. Why? Because this, for the first time this chapter has been introduced in what? CA Inter. They will ask or they will not ask, that also we don't know. हाँ, MCQ question can be asked. चलेगा. Then coming to what? AS 23. We'll take a break of 5 minutes. Then we'll start. Now let us start AS 23. Accounting for investment in associate in CFS. Accounting for investment in associate in CFS. CFS means consolidated financial statement. So what do you mean by associate? An associate is an entity in which investor has significant influence and which is neither a subsidiary nor a joint venture. Correct? Significant influence means what? Power to participate in the operating and financial policy making decision. Correct? So whenever any entity is able to participate in policy decision making, that become what? Investor, and the other entity become what? Associate. Understood? Correct? So significant influence is actually gained by equity ownership. It can be also gained because of some law or agreement also, but normally it is due to share ownership. So some presumption has been taken that any entity who hold directly or indirectly, indirectly always through subsidiaries, 20% more than the voting power, 20% more of the voting power of the investee, it is presumed that entity has significant influence, unless otherwise it can be demonstrated otherwise. So normally it will be presumed that yes, the entity will have significant influence. Means if an entity hold directly or indirectly less than 20% of voting power of the investee, it is presumed that the entity does not have significant influence, unless otherwise it can be demonstrated otherwise. Means in the normal circumstances, if an entity is holding 20 or more than 20, significant influence. If less than 20, no significant influence. Understood? Correct. Now coming to the accounting, so what AS 23 says that for accounting of investment CFS will apply equity method. Equity method. So what is equity method that we are going to understand? So on acquisition of investment will pass an entry investment account debit to cash or bank at cost price. Investment account debit to cash or bank at cost price. But on acquisition we need to find out, we need to calculate goodwill or capital reserve. Means goodwill or capital reserve is nothing but the difference between cost price of investment and the proportionate share in the fair value of INA of associate. Proportionate share means as we used to do in what? In consolidation. So this will be goodwill or capital reserve? Goodwill or capital reserve. So what AS 23 says that we will calculate goodwill or capital reserve but will not recognize it. This is only for disclosure purpose. This is only for disclosure purpose. Means we should disclose that the cost price include how much goodwill. Suppose this is 1 lakh and this is 80,000. So this is 20,000. Means this 1 lakh consists of 80 plus 20. So this 1 lakh is inclusive of goodwill. Therefore no separate recognition is required. So we will not recognize it separately because it is already included in the carrying amount of investment. Already included in the carrying amount of investment. Understood? Is fine. So no separate journal entry will be done for goodwill or capital reserve. Understood? Then already we have done on the date of acquisition what journal entry? Investment account debit to cash. And for goodwill capital reserve no journal entry. Only it will be disclosed. Now for recognition of sharing profit or loss, subsequently the associate will earn some profit. So out of that profit, some share belong to what? Investor. So investor will recognize that profit, the share of profit of associate in their financial statement, in their books of account. So what journal entry will do? If there is a profit, investment account debit to share in profit from associate. If there is a loss, share in loss from associate to investment. Means investment will increase with the share in profit, investment will decrease with the share of loss. Now subsequently when a dividend received, so this dividend received is nothing but withdrawal of that profit. So if the sharing profit was already added investment, now it becomes withdrawal of that profit. So what will do? Bank account debit to investment. Bank account debit to investment. We will pass one journal entry cash or bank account debit to investment. It is as simple as withdrawal of profit in partnership firm. Drawing. It is just like a drawing. So first sharing profit is added. Out of that profit some amount has been withdrawn. So investment will decrease. So journal entry is cash account debit to investment. Understood? Correct? Understood. This much you understood. So can you see if you have understood this much, So how to find out value of investment as per AS 23 on consolidation date? So we'll take cost price of investment including goodwill or capital reserve. In this we'll add or minus investment share in profit or loss, then minus any dividend received, minus any dividend received. Normally they ask this much only in exam. Means till now they have not asked any question of elimination of unrealized profit on stock. But let me explain you about that also. If there is some unsold stock on which we have a profit, so that we need to be eliminated. So this can be also two type of transaction, downstream and upstream. Downstream means goods are sold by investor to associate. Means in the stock of associate, profit of investor is included. Here is a stock of associate will not be recognized in the consolidated financial statement because we are not consolidating that financial statement. But instead of writing assets and liability of associate, we are writing investment. Okay, the stock is nothing but included in the investment. Now if investment is 40%, so stock 40% stock will be included in what? Investment. Means can you say that unrealized profit is actually included in investment to the extent of 40% or 30%, whatever? Are you able to understand what I am saying? So it means investment in consolidated financial statement is overvalued by that proportional share in URP. Therefore you need to eliminate profit from that investment account. So what journal entry will do? PL account debit to investment, or we can say retained earning account debit to investment. Understood? So what journal entry we are doing? For elimination of unrealized profit, if it is downstream transaction, journal entry will be retained earning account debit to investment. Retained earning account debit to investment. Means it will reduce the investment account, it will reduce the investment value, and therefore what you can see, I have done minus elimination of unrealized profit for downstream transaction only. For downstream transaction only. Understood? However, till now they have not asked this point, they will not ask in exam, I know. But chalo theek hai. But if upstream transaction, so upstream transaction in the stock of investor, profit of associate is included in the stock. So that stock is going to be reduced. The stock will reduce it. Correct now? The profit of which company? Associate. That profit is already recognized in the books of what? In the books of investor as what journal entry investment account debit to share in profit. It means you need to eliminate, reduce that share in profit. So what journal entry will do? Share in profit from associate to what? Stock. So share in profit, you can say share in profit from associate to inventory. So it means any elimination of unrealized profit due to upstream transaction will not be adjusted in investment account. So if they normally in exam they ask you to calculate this. So in this only there are how many adjustments? 4 adjustments. First adjustment is what? Plus share in profit, minus share in loss, minus dividend received, minus URP related to downstream transaction, but only to the extent of their share. So all are proportionate amount. All are proportionate amount. This become value of investment as per equity method as on reporting date. This much only you need to remember. Any intercompany debt will not be cancelled because that is not recorded only in consolidated financial statement. So any intercompany debt will not be cancelled. Understood is fine. Correct. Now there is one special point about carrying amount of investment, about post acquisition loss. Any associate can incur some post acquisition loss, and the share in loss is more than the carrying amount of investment. So whether investment can be negative? Well, no, investment cannot be negative. In that case, we recognize only that much share of loss to the extent of carrying amount of investment. Means there may be some share of loss which remain unrecognized. Let me take one question. Suppose A Limited purchased 30% equity share of B Limited on 1/4/2015 at rupees 5 lakh. What is the initial cost price? 5 lakh. Then in the subsequent year 15-16 there was a loss of 10 lakh. So 30% of 10 lakh how much? 3 lakh will be deducted. So this will become 2 lakh. This will become 2 lakh. Next year there is a loss of what? 15 lakh. So 15 lakh into 30% how much? 4,50,000. But how much we can recognize? Only to the extent of 2 lakh. So it becomes nil. Means how much we can't recognize? 2,50,000 remain unrecognized. That will be unrecognized sharing profit, sharing loss of associate. Now next year we have earned profit 10 lakh. So what is the share? So how much? 3 lakh. So out of this 3 lakh, first we'll adjust what? This minus 2,50,000. So balance is how much? 50,000 will be added to what? So 50,000 will be added, and this will become the carrying amount of investment. Understood? Simple. So they may ask this type of question also. Chalega. Then discontinuing the use of equity method. When to discontinue? So it will be discontinued when it ceases to have significant influence. So when it ceases to have significant influence, then we'll discontinue the use of equity method. Or when the use of equity method is no longer appropriate because the associate operate under a severe long-term restriction that significantly impairs its ability to transfer the funds to investors. Similar point we have done in joint venture. Correct. This mechanism from the date of discontinuation investment will be recorded in the financial statement as per AS 13. As per AS 13. Exemption from equity method. When investment are held for the purpose of sale, when it is acquired exclusively with a view to subsequent disposal in near future, or it operates under severe long-term restriction, then it is exempted from equity method. When they are exempted by equity method, then it will be reported in the financial statement as per AS 13. Done. This chapter is also over. So in this, only this statement is very important. So there are few questions given in ICAI study method that you do for revision purpose. Out of that, the question, one question they will ask in exam. From this chapter, question can be asked. Means when I say AS 23, AS 27, AS 23 I feel more important from exam point of view. AS 27 they may or may not ask. It may be asked, because don't take everything as granted. Chalega. I think all chapter done. So let us come to last AS1. AS1 is what? Very simple. Accounting policy. What is the meaning of accounting policies? Accounting policy refers to the specific accounting. AS1. Accounting policy refers to specific accounting principle or method of applying that principle in the preparation and presentation of financial statement. In the preparation and presentation of financial statement. What is the fundamental accounting assumption? There are three fundamental accounting assumptions: going concern, accrual, consistency. Correct. Now, if fundamental accounting assumptions are followed, no disclosure required. But if it is not followed, separate disclosure is required about the fact. Understood? Okay. Going concern, consistency, accrual, you can read. Then selection of accounting policy. How to select accounting policy? That depend upon some primary consideration and major consideration. Primary consideration means whatever accounting policy you are selecting, that should give true and fair view of financial statement. Major consideration means you should select by giving the following consideration into accounting treatment. First is what? Prudence. Prudence is nothing but conservatism. Prudence. Second is what? Substance over form. Third is what? Materiality. Now prudence, we know that financial statements should be prepared on the basis that we should recognize only what? Expected losses, but we should not anticipate any expected gain. Understood? Prudence, okay. Substance over form means what? Whatever accounting treatment we are following, that should be based on reality, not based on legality. Means we should give importance to the actual happening of the transaction, not the legal document. Materiality, of course, the financial statement should be prepared based on those information which are material to the user of financial statement. Means any information which are immaterial or insignificant, that should be ignored for disclosure purpose. Disclosure purpose. Understood? Correct. Then manner of disclosure, what AS1 says, that all the significant accounting policy which has been adopted in the preparation and presentation of financial statement should be disclosed in one place. In one place means in notes to account. Correct. So should be disclosed. Should be disclosed. We should form part of the financial statement at one place. At one place. Chalega. Now disclosure of changes in accounting policy. This is already we have in AS5. So changes in accounting policy, if it give material effect in current period and it can be determined, then amounts will be disclosed. If it cannot be determined, facts will be disclosed. If it is expected to have material effect in later period, then fact of such change will be disclosed in the year of change only. Year of change only. Understood? Correct. This is AS1. AS1 is very simple. You can read it. Now coming to one more AS. That is what? AS3. Come to AS3. AS3. Cash flow statement. This already we have done in class with a separate chapter. So we'll just have a revision of what? The content of this chapter. So cash flow statement is very simple. It is a cash flow means what? Inflow and outflow of cash and cash equivalent. Cash and cash equivalent during the year from three activities: operating, investing, financing. What do you mean by operating activities? Operating activities is principal revenue producing activities. What do you mean by investing activities? Acquisition and disposal long-term asset or investment other than cash equivalent. What do you mean by financing activities? Activity that changes the scope of equity or borrowing of the entity. Scope of it changes the composition of what? Equity and borrowing of the entity. When I say borrowing, it can be long-term borrowing, it can be short-term borrowing. Now there are some activities which are not principal revenue producing activities, and also they are not investing and financing activities. Then they will be assumed to be operating activities. So any activities which are not financing, which are not investing, will be considered as operating activities. Chalega. What do you mean by cash and cash equivalent? Cash include cash in hand and demand deposit with bank, means current account balance. Cash equivalent means what? Short-term highly liquid investment. Short-term highly liquid investment that are readily convertible to known amount of cash and which are subject to insignificant risk of changes in the value. Insignificant risk. When I say short-term is 3 months or less than 3 months from the date of acquisition. The best example is any FD having a maturity period of 3 months or less than 3 months. Any fixed deposit having a maturity period of 3 months or less than 3 months from the date of acquisition, that become a cash equivalent. Understood? Chalega? Yes, sir. Then cash flow statement will be covered in three activities: operating activities, investing activities, financing activities. For investing, financing, always we use direct method. Direct method means cash inflow minus cash outflow. But for operating, they have given two options: direct and indirect. Direct means inflow minus outflow, but indirect means adjustment to profit before tax. Adjustment to profit before tax. Format remain very simple. Cash flow from operating, investing, financing, of course we should disclose under that. And then we'll calculate increase or decrease in cash and cash equivalent. We'll add opening, then the balance will be closing cash and cash equivalent. Now, only I will do a revision of an indirect method. See how to calculate cash flow from operating activities under indirect method. So we start from what? Profit before tax and extraordinary item. This can be taken from SOPL. If not given, we need to calculate it. So first calculate as a working note profit before tax and extraordinary item. Then we do adjustment for non-cash item and non-operating item. Non-cash item and non-operating item. So any expense will be added and income will be deducted. Non-cash expense will be added, non-operating expense will be added. Non-cash income will be deducted, non-operating income will be deducted. Can you give me some example of non-cash? Depreciation, amortization, then provision, creation of provision, reversal of provision, etc. Non-operating means what? For example, interest income, interest expense, dividend paid, gain or loss on sale of PP, etc. Correct. Once you have done this adjustment, we will calculate operating profit before working capital changes. Working capital changes. So this, so you know, we will do some adjustment for increase in asset, decrease in asset, increase in liability, decrease in liability. But which asset liability? Operating asset and operating liability, means operating current asset, operating current liability. Understood? So all current assets are not operating. There may be some current asset which may be non-operating. For example, interest receivable, interest payable, that adjustment will not do. So only operating asset and operating liability. Now increase in asset will be minus ki plus, minus, decrease plus, and reverse for liability. That too you have understood. After this we'll calculate cash generated from operations. From that we deduct income tax payment, that will be cash flow from operating activity. Then we'll plus minus any extraordinary income or expense, that will become net cash flow from operating after extraordinary item. Understood? Correct? Understood. Now there was some special point we have done. If you are preparing any cash flow statement for financial company means banking company or non-banking financial company, any financial institution. So purchase and sale of investment in shares and other securities will be operating activity. Cash advance or loan given will be operating activity. Any interest received will be operating activity. Any deposit from public will be operating activity, means saving account deposit, current account deposit. Any interest paid on deposit will be also operating activity. However, for other financial company, means which are not financial company, this will be investing activity, this will be investing activity, this will be investing activity, this will be financing activity, this will be financing activity. It means interest and dividend for financial company and other company. Interest paid will be what? Operating, financing. Interest received will be what? Operating, investing. Dividend received will be operating, investing. But be careful about dividend paid. Dividend paid for both will be what? Financing activity. Danger. Understood? Then about taxes on income, what is it? Taxes on income will be normally classified as operating activities unless otherwise specifically identified. For example, any TDS on interest received, if that is given the question, then interest received is investing activity. So TDS will be also investing activity. So if it is specifically mentioned, then classified as investing or financing, otherwise it will be what? Operating activities. Chalega? Yes, sir. Then non-cash transaction. So what AS3 says that any investing or financing activities do not involve the movement of cash or cash equivalent will be a non-cash transaction, which will be excluded from cash flow statement, only that require a disclosure by way of notes. For example, conversion of debenture into equity, acquisition of asset by issue of shares or debentures. So if you have acquired some asset by issue of share capital, so PP account debit to share capital, there is no cash movement, so it will be outside the scope of outside a cash flow statement. It will not be included in cash flow statement. Chalega? Yes, sir. Then foreign currency cash flow. I think last point we have done about foreign currency cash flow. So any foreign currency cash flow will be recorded at transaction at exchange rate. Transaction at exchange rate. And due to translation of foreign currency monetary item, there is some exchange gain or loss. That exchange gain or loss may be realized or unrealized. So if it is unrealized, that do not involve any cash movement. So unrealized cash flow will not be considered in indirect method. So that will be eliminated. If you remember. So unrealized exchange gain or loss from changes in foreign exchange rate are not cash flow. Are not cash flow. For example, suppose you have done one sale, debtor account debit to sales at $10,000 into 70. It becomes 7 lakh. 7 lakh, na? Now out of these, suppose 4,000 collected. So bank account debit to debtor, you will do na? And 4,000 was collected at 75. So how much exchange gain? So 4,000 into 75, how much? 3 lakh. And 4,000 into 70, how much? So how much gain? 20,000. Now how much remain uncollected? So can debtor being a foreign currency monetary item require translation at closing exchange rate? Suppose closing rate is also 75. So there is an exchange gain. So we will do 6,000 into what? 5 na? Initially 70, now it becomes 75. So how much? 30,000. 30,000 na? So okay, this is realized gain. This is unrealized gain. Unrealized gain. I hope you understand it. Have you understood this point? Correct. Now, if you are using direct method, We write down collection from debtor. Collection from debtor is what? 2,80,000. Sorry, 3 lakh. And 3 lakh is inclusive of what? Realized gain. So no adjustment required. It will be automatically adjusted. But if you are using what? Indirect method. You start with profit before tax. Profit before tax. Understand what I am saying? So profit, whatever is given. From this you will eliminate what? Unrealized gain or unrealized loss. How much? 30,000 will be eliminated. This will become what? Operating profit before working capital changes. Now, when you are comparing debtor you will find out increase, decrease. So opening balance and closing balance you will compare. So closing balance you will take 6,000 into what? 70 ki 75? 70. You will take 70, not 75. Because you have eliminated this transaction now. So for comparing to find out working capital changes, take assets and liability at original rate, not at closing exchange rate. Understood this point? Have you understood? So this already I have explained in the class. You understood this point? Revise wa? Have you understood this point? Till now no question have been asked from this point, but can be asked. Can be asked. Chalega? Understood? Now balance question 2 as practice. So I think overall we have done all the accounting standard. AS 21 and AS 14 that require what? Full understanding of the chapter, that is revised from the class notes. Okay? Chalega? So today this much only. Thank you very much. Bye bye. Take care. Any doubt what you can do, you can message me. If required, we'll have a session on that also. Okay? Thank you.